tax bills were actually put out in a very timely way. The second installment as early as June, with a due date of August 1 this year. That certainly, as we know, has been unprecedented. And as we've talked about the importance of maintaining adequate reserves, that we, only a few years prior to that, we actually were seeing tax distributions as late as November, December, and January of that year. So almost nearly 50% of a year had gone by without any distribution of taxes. The Truth in Taxation Act requires the board to determine a proposed levy almost 20 days, actually at the amount of 20 days, at least 20 days prior to final adoption. If the proposed levy amount exceeds 105% and it does exclude the debt service fund, then a public hearing must be held prior to the levy adoption. It's been our practice, though the levies have not been in excess of 5%, that we've had those public hearings. Now, based on our requirements in the calendar itself, the following calendar has been laid out here, that at the next Board of Education meeting on November 8th will be actually the meeting that will review again the levy material for your discussion and then actually determine the amount of the proposed 2012 levy. The public hearing and the levy adoption then will be planned for December 13th meeting. There are several key factors that I want to highlight with respect to the 2012 levy that's coming up. First of all, in play is the assessment process. And as we know, back in 2009, at the Cook County level, they actually established a reclassification of properties all into two levels, a 10% for residential properties, and then actually all commercial and businesses and industrial properties to be at 25%. Now, the second factor is that equalization factor, the multiplier. And what we've seen is actually a decreasing trend in that multiplier. And again, that's based on actual sales data ratios. And it actually is related to the first aspect of the assessment, because as that was actually implemented, and since the Department of Revenue looks at 3 prior years of actual sales ratios to determine that multiplier, we're beginning to see that decrease in the multiplier. And we believe that that trend may continue, and as we're looking at even projections for future equalized assessed values across the entire district. Now, another factor that's not necessarily widely known by our public is the phase out of the 7% expanded homeowners exemption. This was actually put into place several years ago and then was renewed legislatively and has actually been decreasing. And so for the 2012 year is actually the last year of that phase out. It went from initially at $20,000 of exemptions. And again, you don't actually see this necessarily in your tax bill or any explanation to that, and that's unfortunate, but that's, again, how this is. We've tried to bring this to your information because it is a factor as it goes in. It has a decrease after the EAV has been determined from an individual homeowner's standpoint of exemption. If this law is not renewed after this year, then we'll see a default back to the $6,000 level of exemption. Now, the fourth factor that's listed there is something that's certainly been a key factor for us for many, many years, and that is the volume of appeals that have resulted in significant refunds for us as a district. As well as during the course of the assessment process is the significant volume of, during the window of assessment reductions, where we're seeing businesses being able to leverage that process to their advantage. Unfortunately, the unintended consequence of that has been we've seen is the tax burden shift. And what I wanted to do was to further illustrate that point. And what I've tried to depict in this particular slide here is simply the representation that whenever there is tax relief to one property owner, it must be paid by other property owners. And because of both the total EAV of the school district, which determines our overall tax rate, the proportion of the EAV that a taxpayer may have may fluctuate because it's strictly based on their changes in EAV. Now, in the illustration that I have here, let's just say, for example, in the scenario that in the base year 2011, that we had just 4 taxpayers in our district, just for the illustration purposes. And you can see based on the information on the left part of the slide that the tax bills were evenly distributed, assuming that for that 11 year. Now, highlighted in the middle there, that tan portion would represent a disproportional change in assessment reductions. In other words, let's say residential A got a 1% reduction because of an appeal. The resident B got a 2% reduction, which would be different, based on different evidence that they may have shown. Commercial property C and commercial property D also got varying amounts of actual assessment reductions. So in other words, the changes in EAV were not consistent, and that was simply based on the evidence that they may have shown within their appeal process. The result of that is what shows on the right. The 2012 then EAV of those properties changed from where it was in 2011. That produces then a different percentage of distribution or allocation of the total amount of the tax bill. And as you can see in the far right, highlighted in yellow, that this taxing agency asked for a levy increase of 3%, which is based on the CPI increase. However, because the properties are not uniformly assessed or changed, in other words, they're not assessed properly and differently, is that whatever the end result of that EAV was would reflect in the tax bills. And you can see the tax burden shift as illustrated, where these businesses actually are paying a smaller share of the overall tax increase, and that burden is being shifted to the residential properties. So again, to the point is that businesses tend to benefit greatly by that. And as a result of that, when we get asked the question, you as a board member, even as far as what is the impact of a tax levy on an individual property or resident, it's nearly impossible to predict that based on this particular example right here. Because even within two houses together, there may be a variance of that. I thought this would be helpful for illustration purposes. As a district, we have continued to experience a serious erosion of our revenue from property tax refunds. There has been really, this is a continuing upward trend of this, and these loss refunds are really recognized as losses. Because the refund itself is paid as from prior years' assessment reductions, whether that is a property tax appeal board decision, it could be a tax objection complaint decision. Whatever that was, it was from a prior year payment, and therefore those payments back to those appellants themselves is actually represented, taken from current year collections, and therefore as a loss. On the average, as a school district, we've actually been losing approximately 2 to 3% of our levy each year, which represents, again, millions. And you can see last year was an anomaly from a trend standpoint with 4.5, and actually that was just a timing issue, because we've already seen an acceleration of refunds on the first quarter already of this fiscal year. So this is just from on a calendar year, or excuse me, a fiscal year basis of the 4.5 million compared to the 6 from the prior year. Now this slide best illustrates what I just explained to you, this revenue erosion that I referred to. Now what I've taken is simply just a PDF of one of our daily tax agency reports that we get from the county treasurer. And as you know, this summer when the tax bills were sent out with the due date of August 1, it's shortly thereafter tax distributions begin to come into the school district. This particular tax distribution came in on August 14th, I've highlighted at the top there. And actually on this particular date, we received a total of $12.4 million in distributions. It's not unusual when taxes are all coming in that those are distributed over a shorter period of time. But what I want you to note in here that's noteworthy is that within this particular distribution, that actually the district gave back from those current year collections $195,000, which is almost 2%, but basically, or a little bit less than that, of this particular distribution. So it simply demonstrates. What's unique about this is that many of those refunds, in fact, all of the refunds for the most part, with the exception of a couple in 11, are actually from the years 2006, 2008, 2009, and 2010. There is no means for us as a school district to go back and to recover those dollars that we have lost. So in 2012, it being a non-reassessment year, and the fact that we recognize this phase out of the 7% expanded homeowners exemption, the always uncertainty of our Cook County multiplier, which we really don't know that until next, probably early summer, we're projecting that we're not going to see any growth. If not, we're going to see a decrease in our overall EAV as a school district to continue with that trend. However, what is unique for this year is the fact that there's going to be a new property opportunity of accessibility for the Schaumburg Town Square Tax Increment Financing District, the Schaumburg TIF, we'll refer to it. That expires in 2012. The TIF district that was established back in 1989, and after 23 years is finally available now for access by the school district and all taxing districts that are subject to that particular area to access that, actually the increment between the actual EAV of the property and what the frozen EAV was back in 1989. So after 23 years, we have a unique opportunity to access that. And I've reflected that in our new property estimates. What you'll notice from the two charts there is that there's a trend in the decrease of the district's EAV over the past couple of years, and that's a function primarily of that decrease that we talked about in the multiplier, as well as the prior reassessment year, which we saw a decrease of. What it corresponds to is that whenever there's a decrease in the EAV, when there's any kind of increase in the levy itself, it will produce a higher tax rate, and that's also reflected in our tax rates corresponding over the last 2 years. The CPI, or the Consumer Price Index, is our ultimate key driver or factor that's looked at with respect to the property tax cap law itself. And in calendar year 2011, that CPI increased 3%. Therefore, for the 2012 levy that's coming up, that will serve as the limitation factor within that law of 3%. Now, given the unpredictability of the CPI, we are continually trying to monitor our projections and based on inflationary factors and making adjustments to those. In fact, the CPI was just released this past week and it was at 2%. For the purpose of our projections, I'm basing it at 1.8% because it constantly changes even on a month-to-month basis. We are projecting very minimal growth for next year with the exception of this new property estimate that reflects the EAV accessibility for the Schaumburg TIF. Now, the levy reductions that were in play for the past several years has been very positive. That abatement strategy we implemented back in 2007. It has actually produced an overall lower average than the CPI. And in the chart that I've summarized here over the past 6 years is that on the average, District 211's levies have been about 2.2% compared to the CPIU, which is the tax cap limit of 2.4%. And if you look in the middle years there, from 7 to 8, is when we actually saw some significant decreases. And that did reflect that overall plan to reduce the tax levy in the debt service fund, and we began doing that incrementally to the point which is where we are currently today at $20.4 million of actual reductions in the tax levy that we've made by using existing reserves, and that will actually projected to grow after this next coming levy to $24.3 million. So overall, as we look at this TIF that's coming out, is I wanted to actually just give you another further illustration, understanding of this and what it represents. In 1989, it had a frozen EAV of $11.7 million for that Schaumburg TIF area. So property taxes then for all districts were really frozen at that point. So as a school district, we've been receiving the taxes based on that EAV on an annual basis. All the properties in there, as they've been developed over the years, the increment dollars that it's shown in the TIF there, which now is actually a difference of $30.4 million, those taxes that were paid during those 23 years were used to dollars by the village itself for infrastructure, for improvements for that, and for their actual debt that they used for the TIF itself. At last, the last EAV number that we have for this Schaumburg TIF is, for 2011, was $42 million. That has decreased, and I factored in a slight decrease going forward with that, just based on a projected EAV for 12. but we're estimating close to a $30 million increment that will be accessible on a one-time basis. And then in subsequent years, certainly this becomes part of our overall tax base. As we look specifically at our levy, the proposed levy for 2012, the recommended amount for the proposed levy for 2012 is $204.6 million. And this represents an aggregate extension of 3.5%. And again, why the 3.5? That represents 3% as the tax cap limitation, plus access to that Schaumburg TIF, as well as additional new property that we anticipate overall for the district of about, again, 0.5%. The debt service is obviously not part of the tax cap limitation, and we've separated that, as you can see, just within our representation of that as a below the line. And because we've been maintaining a level debt service, we anticipate no change in that levy, debt service levy. So overall, the overall levy for the school district would be $210.1 million, which includes the debt service. Specifically addressing the debt service, we are moving forward with our recommendation to fund the life safety bonds for those mandated projects. We are recommending that it be reviewed in two phases. The first phase is currently with recommendation of the $16 million. The goal that we have here is that in subsequent years that we're going to be able to keep this debt service level throughout the term of the debt service itself, and that we're going to be layering it in so that it does not represent any change in that debt service levy itself. It keeps it constant. We're keeping that constant at approximately $5.3 million as illustrated in this particular graphic. We're keeping the debt service very short in this maturity schedule. For example, this particular $16 million bond issuance has a 4-year debt service schedule. And as we looked at the layering of the next consideration, which would be in 2015, when the board considers it at that time, it also has a very short debt service schedule, just keeping this constantly. To bring this into specific numbers here, we have to date, and I wanted to highlight this, we've talked about this levy reduction and the givebacks to our public. We have done this. To date, we are at $20.4 million. That's something that began back in 2007. We have very purposefully reduced our overall debt service, the extension itself, with use of working cash dollars to help offset that. That has increased, as you saw, initially at $3 million to $5 million to 3.7, and is projected to be 3.9 million for the 2012 levy. At the conclusion of this coming levy, we will then be actually at about $24.3 million of total givebacks. Now, I have not highlighted anything beyond the 2012 levy, just simply based on the plans that we have and how we're layering the proposed bond issuance. All that's highlighted in this chart that's applicable and the best information that we have would be that the first phase is the life safety bonds in 2012. That's highlighted in yellow. The turquoise figures are something that will be considered later on down the board. It's just based on an estimate currently, but also from a planning standpoint, how we will maintain the debt consistently. Why levy at the overall tax cap limit? Like most school districts and most taxing districts, is that we're very dependent upon local property taxes. Not unusual for us as a school district, in similar to ours, is the property taxes account, in our case, for nearly 85% of our overall revenue. And actually, over the years, that has increased. And the reason that it's increased is because both state and federal funding has not increased. And so therefore, as we operationally, as we've grown, is that has become a greater apportionment of our overall revenue. Therefore, it behooves us to continue to maximize our levies based on the limitations, based on the program that we continue to support. As we have already reviewed over the past even year, that we've seen various pieces of legislation that have been advanced that are looking to actually provide for restrictions in levies, even from the standpoint of freezing levies completely based on a reduction in EAV. And so as we anticipate potentially changes would occur, we're certainly aware, as we read the newspapers, about the potential pension reform and the implications that that will have potentially on local school districts where there are considerations to bring in costs directly to the school district of paying some of those liabilities and benefits on behalf of those teachers.
Mr. Torres, since that was brought up earlier, could you give more detail regarding some of the pension legislation that we've heard about that could potentially impact us and the significant impact that it would have on us financially?
And some of the various variants of legislation that have been advanced is certainly there's been consideration of imposing actually what's passing back to the school districts was referred to as the normal cost. In other words, the cost of the pensions that is relative to those particular teachers. That certainly makes up funds. TRS pensions are funded by members themselves, by investment income, and by the state of Illinois. And all school districts have maintained their commitments to those costs. In other words, we've paid, all members have paid their share by mandate. School districts have had some costs that we've paid those. It's certainly much of the reason we're in the financial situation in our pension system is because of the state's shortfall and not meeting their portion of their commitments. What we see in the most recent proposal is that there's a phase-in that would bring in potentially those normal costs of approximately 1% per year, phased in almost to 8%. That represents about $1 million per percent for us as a school district. So eventually we could see almost an $8 million cost on an annual basis as an additional mandate of the school district, and that would have a significant impact on our overall program. Maintaining adequate reserves allows the Board of Education to be in a position to be able to respond appropriately from a timing standpoint as it reviews its program itself, and to be able to have a minimal impact, hopefully, on our overall program that we have, structurally as well as operationally. The thing I wanted to mention also, in this particular significance of why levying at the cap itself, would be a point that I have listed here as points 5 and 6 specifically. That's a very real concern that all school districts are experiencing. That's the loss of those tax, those refunds, through the refunds themselves. And actually, we're not even actually getting our statutory level based on the fact that we're giving back some of those dollars. The way that the tax cap formula is set up is that if a school district were not to levy at a maximum, it actually establishes a lower base. In other words, the tax cap formula takes your prior year levy extension base and applies the formula for subsequent years. By lowering the levy, in our case, just by way of illustration, it's about a $1 million loss or less than levy per 0.5% of reduction that would compound then thereafter annually. It produces what I would refer to as like a cumulative effect, where we as a school district would not be able to recapture those reduced levies anytime into the future. And the fact is on an aggregate basis, it actually does have a compounding effect. So therefore, again, it points to the fact that as we have levied at maximum, that as a school district, we have been sensitive to those increases, and we've continued to look at ways we could reduce that levy, and we've done that over the past several years to the point of $20.4 million to date through the abatement process. As we've developed looking at levy scenarios, what I wanted to illustrate those was simply take the levy itself and to further extrapolate out the impact of a non-accessible levy, what it would look like. In the base year 2011, what I've illustrated for you would be what our actual aggregate extension would be. It's about $197.7 million. That if the school district decided to levy at our maximum of 3.5%, which is the CPI cap, plus the new property access, is that we anticipate that our 2012 levy will grow to $204.6 million. And again, this excludes the debt service. If a consideration is to reduce that to either 3% or 2.5% or 2%, you can see that the impact that would have is that would reduce the levy. That's close to that $1 million that I was referring to. So if the levy were considered to be at 3%, we could see a $1 million differential of about $203.6 million. If it was at 2.5%, it would be about $1.9 million differential, or 3. And then when you simply take that revised base, based on your actual levy extension for 2012, then when you consider your 2013 levy next year, that becomes the new base. And now you have a compounding effect based on what you're levying. And I simply just assumed even a maximum of like a 1.8% tax cap on top of that. In all levies going forward, you can see how it begins to compound itself. So a 3% levy this year could result in a $2 million loss after next year. A 2.5% levy this year would result in a $4 million compounded loss after next year. 2% levy would result in a $6 million after next year. And actually then, in subsequent years, you can just keep keeping this going forward, it doubles. That's the compounding effect. And so therefore, as we consider some of these potential costs that are coming to the school district, this is a significant factor to consider. As difficult as it is, when you're dependent upon local property taxes to fund your operations, that this is an important factor to understand for the decisions that are made in the short term for the long-term effects. As we maintain our financial projections, what I've done here is simply just taken our main operating funds, which are really the most significant: the educational fund, operations and maintenance, transportation, municipal retirement, and working cash. The other restricted funds would be like your actual debt service fund, your capital projects fund, or even the life safety fund. And what we're starting to see within this projection is that while the district does maintain a very healthy position financially, that if you just based on those projections going forward, based on the information that we have here, I've also made an assumption that we're going to continue to maximize those levy increases in each subsequent year through the 2016-2017 year. And as while you see that the projection will show that it does still show a positive ending balance as far as on an excess basis, you start to see the challenges that is to maintain a level of adequate reserves. And certainly the unknowns that we have, anything going forward with 2014 and on, as we look at collective bargaining agreements that are all going to be subject, as well as any changes with respect to legislation and other mandates. I did want to highlight on this slide, as I talked earlier about the volatility of state funding and why we need to levy at max in these levies locally, is because the only revenue line that is consistent and that is really functioning from year to year is that local level. If you see on the state level, is that virtually from FY12 to FY17, I'm projecting no change in the level of state funding, and that's just a function of where we see our overall state. Using those same scenarios that I've shown on the previous slide, I wanted to illustrate the impact that would have on our overall budget balance itself. And I did this for the purpose of, rather than giving you 4 or 5 different levels of projection information, I simply have just taken a bottom line. In other words, when you would change the level of property tax based on the levy itself, and just for the illustration purposes, I just kept the expenditures in our projections consistent through the period of our projection. In other words, what's going to be the impact of the program? So those are consistent. And what changes then is really your direct revenue. And so what I've shown in the first yellow line at the top there is what we anticipate. It reflects the previous information I shared. And that levying at the maximum, we do see a positive balance into the future. We do start to see a tightening with respect to our revenue and expenditures being in alignment. When you apply a change in a year, in this case, if we reduce that levy and not levy at the maximum, I just simply changed the revenue in the projection to show the actual deficit that would occur. And I just want to translate that as we would not allow that to occur. It effectively means is that would represent the level of reduction that we've had to make in our expenditures to keep a balanced budget. Hopefully that is understandable in my illustration. Again, it represents, again, the level of reduction that would be a consideration to maintain a balanced budget.
Can I ask a quick question? So in other words, what you're saying is that reductions in the program would have to be made in order just to break even without even necessarily having a substantial surplus?
We're gonna be able to maintain that surplus. This is simply indicating that we're gonna be either, your choices are either you're using your reserves and it's gonna be in a compounding effect. Because what I want you to recognize is that my projection is just based on the size of the paper that I have here to work with to 16, 17. And so therefore, on this illustration, is that